you put out a controversial view that it's possibly not an inflationary environment that we are going to see in the US next year, that it might be deflation.
So I was about 4 or 5 months ago, I was very uncomfortable because my view is that the inflation we were seeing was temporary, transitory, if you want to use that word, that it would be coming down, we would get into disinflation. And I found myself in agreement with the Fed, and that made me really uncomfortable. They're always wrong. Maybe I'm wrong, but so I was happy the other day when they threw transitory overboard and said it got on the inflation bandwagon. I said, okay, well now I feel more relaxed because I'm disagreeing with them, and that's a good place to be. So yes, they did get rid of that. I think, let's bear in mind, we just went through Jay Powell's announcement, and he's going to have a Senate confirmation hearing, and there's a political aspect to this. And so he didn't want to be on the wrong side of that politically. Whether I'm not saying there was some, behind the scenes deal with the White House, it's not possible, but we don't have to assume that. I think it was just Jay Powell, the Washington politician, as much as the central banker saying, okay, I'm getting beaten up over this, let's just take that off the table. The stronger inflation that we saw in March, April, May, June, and basically through most of the summer, a lot of that were what are called base effects, meaning, so how do we actually report inflation in the United States? Well, we do it on a monthly basis, but it's year over year annualized. So take the month of May or the month of June, the month of July, 2021, compare it to May, June, July, 2020, and take that year over year increase and then annualize it kind of, times 12 if you want, a little more to it than that. And that's your inflation rate. Well, what was going on in 2020? It's the lockdown, it was COVID. The US economy was flat on its back. So of course you had price declines. So when you get a year down the road to 2021, you would expect those prices to be higher, not because everything's out of control, but because the prior year was so weak. And if you're doing it year over year, which is how they do it, you're going to get some pretty hot numbers, and we did. So that was to be expected and not cause for concern. The real crunch came more recently in September, October, and now I think we'll be getting the November numbers in a matter of days. And there, the third quarter, 2020 third quarter, was one of the strongest quarters. We had a steep drop, and then we had the bounce back in the third quarter, one of the strongest quarters in US economic history. So the base effect went away, and now you really are looking at something that's maybe a more legitimate comparison, and it was still a little hot. So then you're like, well, okay, is that COVID? Is that supply chain? Because supply chain was not as big a factor. Maybe the supply chain was breaking down a year ago, but nobody was buying anything because nobody went outside. Now all of a sudden the shoppers are back, and we're finding bare shelves again. It's not just the paper goods aisle at Costco. It's one of our big box stores. It's everything. So we're seeing supply chain effects, and that would tend to make prices go up because we have a lot of money in the economy and shortage of supply. People are going to bid up prices, and then there's labor shortage, et cetera. So there are a number of factors in play, but then you still begs the question: is it transitory, notwithstanding those factors? Because you only get COVID once, so you only get supply chain breakdown once, then it just becomes the steady state, or is it is something going to change? Now that's a big debate. There are two sides to it. I still lean to the view that that the disinflation is going to get the upper hand. And part of the reason I say that is real incomes are not going out that much. This new COVID variant that's going around, I don't have to tell Australians about lockdowns, but we have our own, and that's bound to slow the economy. The supply chain is bound to slow the economy. So if prices get too high in that world, you could actually tip into a recession. So, $4.50 is US dollars. I know everyone in the world thinks we have cheap prices, but a year ago, Americans were paying $2.25 a gallon for gas, and today we're paying over $4 a gallon for gas. Well, okay, fill up your tank, but that's less money for everything else, dining out, movies, clothes, whatever else you want to buy. So it hurts all those discretionary, consumer discretionary categories if more money is going into the gas tank. So you could have a setup for actual, certainly disinflation. I don't have to go so far as to say deflation, but disinflation, meaning inflation is transitory. And if it gets worse than that, you could even see a recession. Now, not right now, and I'm not making a hard and fast forecast, but you can see that trend. Now, I can take off my deflation hat, put on my inflation hat, and just look at the money supply, look at the government spending, look at the supply chain constraints and say, well, wait a second. If the government's spending, trillions upon trillions in deficit spending, which we are, and there are more bills, more legislation in the pipeline, which it'll get amended in some ways. It's not final yet, but it'll probably go through with another $2 trillion of spending. That much spending in an economy with with declining labor force participation, supply chain bottlenecks, a new brand of COVID going around. What does that do to prices? Well, that might give you an inflationary boost. So, the best answer is there are good arguments both ways. I don't want to sound wimpy about it, but I don't want to put a stake in the ground either. I lean to the transitory camp. I lean to the disinflationary camp. I think part of what Jay Powell's doing is for political consumption. Again, goes back to what we talked about at the beginning of the interview, the power diversification. If you have that diversified portfolio, it doesn't mean that every asset class screams in every state of the world, but some of them will, and they should give you good total returns without too much risk.
Does this mean we're going to see, further dovish policy coming out of Powell, or do you think he'll be able to navigate between the doves and the hawks that sit across the Fed board?
Well, he'll have to do some of that. And bear in mind, even with Powell renominated for his existing seat, and then I guess Lael Brainerd has been nominated for vice chairman. So she was already on the board of governors, but that's a promotion. Good for her. She's one of the big brains there. But they still have, I believe, 3 vacancies. So if Joe Biden wants a dovish Fed, he can have it because he just has to fill those seats. And it's a really consensus-driven organization. And remember, one of the reasons Paul Volcker resigned in the 1980s was he almost lost a vote. I didn't actually lose it, but you don't want, you don't want 7-4 votes, or you don't want 6-5 votes coming out of the board of governors. You want them to be, 11-0, or 9-2, or something like that. Always a couple of dissenters. But if Biden fills those vacancies with doves, and Powell's trying to take a hard line, and he has a couple of supporters, but not that many, he doesn't want to lose a vote. And so it begs the question, does he persuade others to come along with him, or does he join the dove camp? And that remains to be seen. But what you don't want at the Fed are close votes. Again, 9-2 is fine, 11-0, fine, but you don't want 6-5. And if Biden puts in 3 doves as a concession to the fact that he did not make Lael Brainerd the chair, she's the super dove. I have a lot of respect for her as an economist, but she's definitely in the dovish camp. By the way, what Jay Powell's doing right now is hawkish. Because they laid out in November, they laid out the tapering plan. And it's always like watching a movie in reverse, Jay. So you watch the movie and then you play it backwards.